Welcome everybody. Welcome back. If you have been on some of my other webinars, let's start with some commodities today. Crude's quite interesting at the moment. What have I got here? Daily chart. So oil has been in this sideways direction for quite a long period of time. As far as the weekly chart goes, basically we're ranging in between the sort of 500 and the 200 week moving averages and the 100 week moving average, the blue line. The red is the 200, the green is the 500, the blue is the 100. And you can see we've been trapped there since November, 9 months or so. If you're a scalper, that's your range. On the daily chart, we've had a decent run up, and I think we have actually got a head and shoulders pattern here, which there's the left shoulder, then we've got the head, and then we've got the right shoulder, and we've broken the neckline. And the reason I wanted to get onto this quite early is because I think we have a sell signal here in oil. To see it more clearly, I'm going to use the 4-hour chart. Now you can see something a bit more clearly. This is the right shoulder, sorry, the left shoulder here. Then we've got the head pattern here. It's almost a head and shoulders within head and shoulders, because, you know, you've kind of got a shoulder here and then a head and then another shoulder, and then you've got this big shoulder. And that is also quite common for a head and shoulders pattern. So I'm quite convinced that this is what I think it is. And I'm quite convinced that this is the neckline. And I'm quite convinced that the neckline has been broken and that we can look for oil to have quite a significant move to the downside. Is anyone out there trading oil? The fibs will help me measure the target, but I'm just going to go back to the daily. I'm just making sure I've got the fibs from the right place. I have. So what can I tell you? Do you see that the neckline is the blue line there? We danced around the blue line for a little while yesterday. That was a little bit tricky, but we have broken to the downside, I believe. What else is helping me to convince myself of that? Well, we broke, I can put a trend line on here. There we go. We broke that very clear uptrend line there, which sort of coincides with the dotted line from the fibs, with a decent red candle. So that really did show that the bulls were panicking. There were some stops being hit. Then we managed a bounce, and that was held by the 100 and the 50 period moving averages on the 4-hour chart. So they work really nicely as resistance. And why not? Because the blue certainly had been tracking the bull trend on the way up. So maybe it's going to track a short-term bear trend on the way down. Let me move that over a bit. There's two reasons why I think oil could go down at the moment. A, we've broken the bull trend. B, on the retest of the moving averages as resistance, we rejected it and we've come down. Now we have what I believe is the right shoulder to the head and shoulders pattern and the neckline. And we've also just broken below the 200 period moving average on the 4-hour chart as well. Now the neckline is around 78.60. The peak is 84.20. So that's about 600 ticks would be the measured target on the downside, 650 to be more precise. But anyway, so that could take us down to $72. Now, I've got the 61.8% fib in, 73.65, so that definitely looks like a realistic target based on just the maths of that pattern. And it would take us to a nice support level, really, because we do have a swing low, bang on that fib level. We do have some swing highs up here, bang on that fib level. Certainly the 50% looks like a realistic next target. Yeah, the 50% at 75.70 looks like a realistic next target. We've got the red 200-day moving average coming in there as well. So a near 300-point drop would not surprise me at all in oil. I do actually have a small short position on in there just to let you know. You can see where to draw the neckline, which is from the 3rd of August to the 17th of August. Those are the two neckline points. The green 500-week moving average caught the downside again here, and we rocketed higher. Now, the green 500-week moving averages again acted as a support level. So it's something that you need to respect. Sometimes the 500-week moving average does work a bit like magic. Now, I thought we had a double bottom here, but we haven't propelled ourselves up, and we would now need to really break the 500-week moving average, which is around $85, for us to begin a new leg higher in oil, certainly as far as the weekly chart is concerned. Okay, you can see that we're basically ranging from the 200-week moving average. That's now acting as the good support level. Decent test there 4 times, and we're holding just below the blue 100-week moving average. We're actually really kind of catching the 38.2% fib on the bounce. So we are most definitely range bound, as you can see. Okay, so that's all the analysis we can get from the weekly chart. From the daily chart, the bounce from that low $60 area. There we go. Now we've got a correction from this rally that started in the 28th of June from the triple bottom at the low $60 area. Look, 1, 2, 3, nice triple bottom. And actually, if I put a trend line in here, so we also sort of had a triangle pattern. There we go. And then once we broke up through the triangle, off we went. Okay, so I put my Fibonacci levels from that swing low down here, $67 up to the swing high, $84. So I've just isolated that up move that we've got. And we've now corrected down to the 38.2% fib. And that's interesting that that is holding around $77. But the bigger picture for me is the head and shoulders pattern, which is much easier to see on the 4-hour chart. Now, the good thing is my Fibonacci levels will still appear here on the 4-hour chart when I move the time frame. So that's kind of useful. Right, there you go. The left shoulder there, nice and easy. And then you get the head. Now, I could almost argue that that's the left shoulder as well, but I'm going to take it here. But, you do get shoulders and heads within shoulders and head and shoulders patterns, actually. If I went into a shorter time scale here, I could probably show you yet another head and shoulders pattern within it. But anyway, then you got the head, and then the market plunged down to form the neckline, because we get the second low, which is the neckline. So that's why I consider this to be the right shoulder, this to be the head pattern, and then this to be the second shoulder. And the neckline is the blue line. Don't know if you can see it closely enough. Is the blue line that I've joined from this low to this low, and that comes in now at 78.65. Now we're dancing around there, and that is often the case. Unfortunately, technical analysis is never a science; it's more of an art, and you've got to decide, well, are we actually going to eventually collapse? And I think we probably will, but the bulls and the bears are having a good old fight about it right now around that neckline. So it's a kind of place your bets. Do you think it's going to hold as a support level, or do you think it's going to hold as a resistance level? I tend to think it's going to hold as a resistance level. We had got oversold. That's no longer the case. The 200 period moving average on the 4-hour chart, I'm hoping will act as resistance, because I'm actually short oil now as I speak to you. So I'm hoping that this pattern plays out and we sink to the downside, but we're certainly having a decent bounce. Might as well have a look at the 1-hour chart while we're at it. When we get down to the 1-hour chart, I would like to put some more Fibonacci levels on, because obviously we've got a situation where we've zoomed in on the most recent price action. So I'm going to just see where the resistance levels could be with my fibs on here. So now then, $79 would be a resistance level according to the fib on here in the very short term, on the retracement upwards. And that's also tying in with the 50-hour moving average. The black line for me is the 50. I use 50, 100, 200 and 500 period moving averages on all 4 time frames. As long as we hold below sort of 79.00, 79.20, then pressure remains to the downside on oil. And as I say, I think this pattern will play out and down we go. Even if we actually got up to $80, that would still be quite a strong resistance level. So that's it. That's why I think we have a head and shoulders pattern in oil, and that's why I think eventually we'll turn around and go south. When we broke the neckline yesterday, we did sink quite quickly. We sank 150 ticks quite quickly, but since then we've just been dancing around in a range. I'm going to move on to gold. So gold has obviously been in a bull run. I'm sure you're probably aware of that if you're into financial markets. Gold made a low at around $250 right at the beginning of this millennium and rocketed up to 20, what was it? To 1923. Okay, then we had a big pullback, and then we had the next leg higher for gold. Now, this is pretty scary for me. I don't know if anyone got any interest or investments in gold or any interest in gold. Now, actually, there's 2 schools of thought on gold. Some people argue that this is an enormous cup and handle pattern. It can be a very bullish pattern. It's when the market has a correction, but it forms this sort of rounding pattern. Some people that believe that this is a big cup the rounding cup, you can see that cup, and this is the handle to the cup. And then once the handle completes and we break up, then we will soar, because this is a very bullish pattern for gold. I'm not sure if I believe it. I think that we have a triple top here. I don't think this is the handle. The handle isn't playing out the way it should do. And my concern is that this is a triple top. Now, that's quite easy to see. First peak on the 1st of August, 2020, second peak in March 2022, third peak in May 2023. When you look at the monthly chart, the candles also indicate that, well, that's a doji, so that's certainly, we've got a small red body right in the middle of a long upper and lower wick. That's called a doji. That indicates the market's coming back into balance after sort of vacuuming up, showing that probably the rally is over, and in this case it certainly was. The second peak, we have a long upper wick, very long upper wick with a small green body, and again indicating that some strong selling pressure came into the market when we retested the all-time high. So someone wanted to offload gold up in the sort of the 2050, 2070 area. And then we plunged significantly. So that candle really was an indicator that selling pressure was coming into the market. So that candle did do what it was supposed to do. In fact, the second candle also kind of indicated that with the long upper wick and the slightly larger red body. Then we got a second go, a retest at the all-time high. Now, I actually thought, okay, it's going to break this time. We've had a really nice pullback, and we've got some momentum to the upside. Double tops tend to hold, but triple tops rarely do. Triple top is a very rare pattern. And the thing is, I think we do have it, because we've got this long upper wick on the third peak, small red body. Okay, we haven't plunged yet on a monthly chart, but we're certainly not making any form of recovery. We tried a recovery last month in July and August. Of course, we seem to be wiping out that recovery. So my warning is that if this is a triple top, like I think it is, gold can have a significant move to the downside. And I am talking about maybe testing the 200-month moving average down here around 1360. Certainly the 115, around the $1,500 mark is possible. Right, that's very much for the longer term, because that is the monthly chart. But it's something you've got to be aware of if you're trading gold, especially if you're bullish. Onto the daily chart now. You can still see that triple top if I scrunch things up. Again, even on the daily chart, negative candle on the second peak, not on the first peak, not particularly negative, no. The second peak, long upper wick, small green body, that's called a shooting star or an upper test or whatever you call it. And then a big move to the downside. And again, something similar, long upper wick again, showing that selling pressure came in here after a good run up. We seem to be tailing off. Now, onto the daily chart. So I've got in the back of my head that we have got this triple top pattern in gold, and I've got it into my head that maybe we are going to go down. When you look at the daily chart, I'm really only interested in the last rally and breaking down what's happened there. So I will start by putting my Fibonacci retracements on there. Okay, what else can I do? I'm going to put some trend lines on here. Can I argue that as a trend line? No, not really. Trend lines, the basic rule for a trend line is you're joining two consecutive low points or high points. I always use the low and high of the wick. I think you should encompass all the data. I tend to just keep drawing them until I feel like I'm happy with something. I think I'm going to take this low. Yeah, not that these are particularly relevant anyway, but I'm going to put that. I've joined this low here and this low here, the low of the wicks. Okay, and I could probably put a trend line here as well, just to clarify that we are in this short-term either correction or downward sloping. It's a downward sloping channel anyway. It's a question of whether it's a correction or not. Now, once we broke this 38.2% fib at 1903 and also the red 200-day moving average, I thought, that's it. Gold's broken. We should sink basically down to here around 1850. And we haven't. We've turned around and gone up. Now, I don't really understand why we've done that, but nevertheless, we've done it and there's no arguing with it. We're back up through 1905. That was my trigger yesterday to get to signal we're going to have a recovery in this channel. Basically, it was a retest of this previous low. I could put a trend line on here too. I don't know why the market is finding this to be a support level. I'm confused with it, but it is, and that's just the way it is. So yeah, I think we can get up to 1933. We could even get up to the 1950 area. I was putting a few on. Why did I choose that one? Okay, let me try and explain it. This is the last higher low. Do you know what I mean by that? So in an uptrend market, you get higher highs and higher lows, yeah? This was the last higher low because, as you can see, the next low was lower. So I kind of think that this area is important. Do you know what? We're looking at that again. And if I want to be a bit more precise, maybe I should have drawn it from here. Yeah, I think I probably should have done actually. And that makes quite a significant difference. So I've taken the low of that red-bodied candle. It isn't actually, that's actually slightly higher than that point. So it's all a bit, it's all a bit guesswork really. But anyway, that's why I've taken that, because that's the last higher low. Does that make sense? And then, hang on. So, and then it's kind of, I like it because it's kind of parallel with the upper trend line, and the upper trend line is pretty key because it's definitely just joining the swing highs. So I like that channel. I think that's something that we've got to respect, put it that way. Now the upper end of the channel is around the 1950 area. The blue 100-day moving average is turning down now after this last move to the downside. So we have definitely got resistance around 1950, 1955. If we get that far, we may not. We may only get to the black 50-day moving average. I'm going to put some Fibonacci levels on here too, because that's what I like to do, but I'm going to do it on the 4-hour chart because that will also help to give me resistance levels on the retracement. Oh, hang on a sec. I need to go all the way back. Right. I need to go here and I need to go down to here. Okay, there we go. Now look, this is so often happens. It's so mathematical. I don't know if you can see. I've got quite a lot of lines on here now, so it could get a little bit confusing. But I close that up. Okay, so you saw me put the fibs from the high, the all-time high, down to this correction low at 1844. The 23.6% fib is bang on 1930, and it coincides perfectly with my black 55-day moving average. 50-day moving average, sorry. That comes in exactly at 1930. Now, I think that's a reasonable target. I think we can get there, but it's obviously going to be a resistance level. I'm just going to scale that. Now, look also how perfectly, if we were to continue higher, the 38.2% fib is tying in perfectly with the 100-week moving average at around 1959, 1960. So those are the two big resistance levels for me in gold. If we start getting up through 1935, I think we could get to 1955, 1960, which is just above that trend line. But I'm going to go with the fibs and the moving averages rather than the trend line. So that's kind of, yeah, I hope that explains why I drew the trend lines there. I'm looking for areas of confluence, which means I'm looking for areas where the Fibonacci levels line up with the trend lines and the moving averages and the previous price action, which this 23.6% fib does line up with previous price action. Look, that swing low here and that swing low here. Okay, the low is actually slightly below it, but of course the candle didn't close below it. And look, these peaks here, they all tie in so nicely with that 23.6% fib that the 1930, 1932 area should be a good resistance level. And if we are in a bear trend, like I think we are, the beginnings of a bear trend, maybe that will be the peak. It's something that you really have to pay attention to anyway, that level. We're just coming off the oversold situation. Markets can stay oversold I've got the slow stochastic on here. Markets can stay oversold for a significant period of time in a bear trend. Just because it's oversold doesn't mean it's definitely going to bounce. But in a bear trend, you don't tend to spend so much time in the overbought territory, as you can see here. That period here is a lot shorter before we turn down. So maybe by the time we get to 1931, we're going to be just entering the overbought territory area, and we're going to be ready for the next move to the downside. Let me have a look at some of your questions. Does your stochastic not suggest a bullish move? Yeah, okay. Okay, let me go into the stochastic. Good question. Let me blow it up. Okay, so it does suggest a bullish move. I don't think that's why the market turned around there, but you're right, it is. And now that we're building some momentum to the upside. So that's why I jumped into a long position in gold yesterday. Once we broke above that 38.2% fib at 1905 and the red 200-day moving average, I thought, okay, there's nothing holding gold back now from a recovery. And yeah, the stochastics are certainly indicating that. Stochastics are showing that we have some momentum to the upside. I'm going to go to the 4-hour chart. I don't rely on stochastics too much. I like to see if the market's overbought or oversold, but when I was learning technical analysis and I saw all these oscillators, I just thought, oh my God, this is fantastic. Look, every time it gets overbought, it turns down. Every time it gets oversold, it turns up. Look, if you're looking at this for the first time, you're going to be like, geez, that was amazing. Look at this low here. And then look at this high here. You know, it wasn't long before we turned down. But unfortunately, that isn't always the case. If you started getting quite bearish about gold here on the 12th of July, well, we stayed overbought all the way up until sort of 14th of sorry, is that 12th of July? Oh yeah, this is the 4-hour chart. So this is much shorter term. Anyway, 12th of July, start getting bearish around, I don't know, 1950. We didn't really start turning, well, the stochastic, well, we didn't start turning down. We peaked at 1987. So you'd have been 37 points wrong on a short position before the market turned down. You know, the market can stay overbought and continue higher for way longer than you can hold a short position. So I don't trust it. Now, if I am going to use a stochastic, I will use it when I know what the trend is. Now, when the market started trending lower, 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 low, lower, high, lower, low, lower, high, lower, low, you know, okay, oh, hang on, we're getting into either a correction or the beginning of a bear trend. Don't know what it is yet, but it doesn't matter. Now, once you're establishing that bear trend, then you can start saying, okay, well, when it starts to get overbought, I really want to be looking for opportunities to sell. Are we hitting a resistance level, a moving average, something that, you know, that makes me want to get into a short position? And that would work, because when you're in a bear trend, you don't tend to spend too long in overbought territory. And as you can see here, we really didn't. Whereas we spend a long time in oversold territory when you're in a bear trend, and vice versa. When you're in a bull trend, you don't spend long being oversold. So now the question is, we're just getting into overbought territory on the 4-hour chart. Do we have enough legs to get up to 1930, get short, and then see the stochastic turn around and head south, which is kind of what I'm looking to do. I'm long, but I don't want to hold on to it for too long.